Picture this. You've just finished a full day at work, emails stacked, meetings behind schedule, and you sit down at your trading station hoping to squeeze in a few trades before life calls again. Your screen glows, charts shift, and your mind immediately floods with setups. Every signal, every breakout, every candle seems like an opportunity. The temptation to act on all of them is strong. You feel like you need to catch up for the hours you missed during the day, but most of these trades won't move your account forward. They will only drain your energy, your capital, and your confidence. This is where the 80/20 principle, or the Pareto rule, becomes a game changer for part-time traders. In trading, roughly 80% of your profits often come from 20% of your trades. Not all trades are created equal. Some setups have a higher probability of success, better risk-to-reward ratios, and align with your trading edge. The challenge for part-time traders, especially those balancing a 9-to-5 job, is identifying which trades belong to that top 20% and which are just noise. Trying to trade everything is exhausting. When you force trades out of fear, boredom, or the desire to be active, you're tapping into decision fatigue. Cognitive psychology tells us that our brain has limited capacity for high-quality decisions each day. After a long workday, that capacity is depleted. Cortisol levels are elevated. Your prefrontal cortex, the region responsible for rational decision-making, is functioning suboptimally, and your ability to follow your trading plan diminishes. That's why so many part-time traders enter trades impulsively during the evening session, thinking that more activity will create more profit. In reality, it often leads to overtrading, small but repeated losses, and unnecessary stress. Consider a typical week. You track your trades, noting every entry and exit. By the end of the week, you realize that out of 20 trades, only 4 produced significant gains. Those 4 were trades that met your exact setup criteria, had proper risk management, and aligned with the market context. The remaining 16? They were impulsive, driven by the urge to do something with the market, trades taken with a fatigued or distracted mind. Most of these led to break-even results at best, or small losses at worst, quietly eroding both capital and confidence. The science behind this is compelling. Decision fatigue is a real phenomenon. As we make more choices, the quality of subsequent decisions declines. After a long day, your mind struggles to differentiate between high-probability setups and setups that are technically marginal. You rationalize weak trades with thoughts like, "It looks okay," or "I can risk a little more, I deserve a win today." This cognitive distortion is amplified in part-time trading, where time is already scarce. The mind wants to compensate for the lost hours, and the brain's natural reward system, dopamine spikes from small wins, encourages impulsive behavior. The 80/20 principle offers a framework to counter this. Instead of chasing every candle, every pattern, and every alert, you focus on the setups that historically produce the most impact. For a 9-to-5 trader, that might mean trading only during a 60-minute window each evening, scanning for trades that meet strict criteria and ignoring the rest. The discipline to wait for only the highest probability setups reduces errors, limits emotional decision-making, and protects your capital from fatigue-driven mistakes. Once you understand that only a fraction of trades create the majority of your results, the next step is learning how to identify those high-impact opportunities and align your trading with your natural energy cycles. As a 9-to-5 trader, your cognitive resources are finite. By the time you sit down at your trading station after a full workday, your ability to make quality decisions is diminished. This doesn't mean you can't succeed. It means you must be strategic. Start by recognizing your personal energy patterns. Everyone has peaks and troughs in focus, alertness, and mental clarity. Some traders find the first 30 minutes after work are sluggish as their brain transitions out of work mode. Others may be more alert later in the evening after a brief period of decompression. Track this over several weeks. Note the times when your decisions feel crisp, your charts make sense, and your adherence to your trading plan is strongest. This is your high-focus window, the only time you should be actively scanning and executing trades. Situational awareness is critical. Commuting stress, family obligations, and leftover work tasks can all sap your mental energy, leaving you more vulnerable to weak trade decisions. If your trading window coincides with these stressors, you increase the likelihood of entering trades out of impatience or FOMO. A practical approach is to set up a small buffer between work and trading. Even 10 minutes of stretching, walking, or meditative breathing can reset cortisol levels and restore prefrontal cortex function, improving your judgment. Next, develop a trading journal that goes beyond profit and loss. Record your mental and physical state before, during, and after each session. Include metrics like fatigue level, emotional state, distractions, and focus. Over time, this data reveals patterns connecting energy, cognitive performance, and trade quality. For example, you may notice that trades taken immediately after a long meeting or a stressful client call are rarely profitable, whereas trades taken after a brief reset are more precise. Follow your plan and align with your risk rules. The high-impact trades you want to target share common characteristics. They meet your established criteria precisely: proper technical setup, strong risk-reward ratio, and alignment with market context. When scanning the charts, focus exclusively on these opportunities. Ignore the setups that look okay or maybe. These are the trades that drain your energy without offering meaningful results. Your goal is not to be constantly busy, it's to be highly selective. Cognitive biases often make this difficult. Confirmation bias, the urge to do something, and the fear of missing out push part-time traders toward mediocre trades. You might tell yourself, this one looks close enough, or I'll take a smaller position since I don't have time to wait. These rationalizations erode the 80-20 principle. Awareness is the key. By noting every moment you feel an urge to deviate from your plan in your journal, you train yourself to recognize the warning signs of low-quality decision-making before executing a trade. Structuring your trading session is equally important. Limit yourself to a set duration, like 30 to 60 minutes, during your high-focus window. Define the maximum number of trades in advance. This creates artificial scarcity, which forces discipline and ensures that you only enter trades that align with your edge. During this window, eliminate distractions. Mute notifications, close unrelated apps, and focus solely on scanning, analyzing, and executing your predefined setups. A practical example: imagine you've identified 2 potential setups during your 45-minute window. One meets every single criterion: technical alignment, proper risk-reward, and market context. The other is marginal, with slightly weaker support levels. Using the 80-20 mindset, you only take the first trade. The second is ignored, even though your mind may argue, it's fine, just a small position. By consistently prioritizing quality over quantity, you ensure that each trade has the highest probability of contributing to your cumulative results. Another tool is pre-session preparation. Before opening your charts, scan the market for potential high-probability setups. Identify the trades that fit your criteria and mark them mentally or in your journal. When your trading window begins, you focus exclusively on executing these pre-selected opportunities. This approach reduces the cognitive load of constantly scanning and eliminates impulsive entries, which are the leading cause of part-time trader mistakes. Reflect on past sessions not as a summary of outcomes, but as a study of your decision-making process. Ask questions like, were my entries precise? Did I skip any setups that met my criteria? Did fatigue or stress influence my choices? This reflection improves your ability to consistently target the 20% of trades that produce the most meaningful results, reinforcing the discipline needed for part-time trading success. Understanding the 80-20 principle is only half the battle. The next step is structuring your trading sessions so you can execute high-quality trades consistently, even with a full-time job. The key is to create rituals and routines that shift your mind from work mode into trader mode, protect your energy, and maximize focus within your limited window. Start with a reset ritual. After a long day at the office, your brain is saturated with decisions, deadlines, and stress. Trying to jump straight into charts is a recipe for impulsive trades. Take even a short break. 10 to 15 minutes of stretching, light exercise, or walking outside helps reduce cortisol levels and clears mental clutter. Some traders find journaling or a brief meditation session especially effective for aligning focus. Write down how the day went, any emotional baggage, and remind yourself of your trading plan. This clears space in your working memory for precise, strategic decisions. Next, design a structured routine for your trading session. Even if you only have 30 to 60 minutes, every action should be deliberate. Check your watch list, confirm your criteria, and identify entries that meet all your rules. Then, go through a pre-trade checklist. This should include verifying risk-reward ratios, position size, stop-loss levels, and market context. The checklist acts as a cognitive anchor, preventing fatigue and emotion from dictating behavior. Limit the number of trades per session. Part-time traders often feel the pressure to make up for lost market hours. This leads to overtrading, chasing setups, and straying from their plan. Set a maximum number of trades that aligns with your high-focus window. For example, 2 to 3 high-quality trades in a 45-minute session are far more effective than 6 low-probability trades. Scarcity creates focus, forces discipline, and ensures each trade is meaningful. Timing is crucial. Align your session with your personal energy peaks. Some traders feel sharper immediately after a short reset. Others find clarity an hour later. Track your energy levels in a journal and schedule sessions during your most alert periods. Avoid trading when your mind is fatigued from commuting, work stress, or family obligations. Your trading plan is only as good as the clarity you bring to executing it. During the session, eliminate distractions. Silence notifications, close unrelated apps, and create a workspace that signals trading mode. Physical and mental cues reinforce focus. Some traders even use small rituals, like a cup of tea or a specific playlist, to mark the transition. These subtle cues strengthen the mind's association with discipline and deliberate action. Risk management must be non-negotiable. Stick strictly to stop-loss levels and position sizes determined before the session. Fatigue and impatience can tempt you to move stops or increase size to catch a move. By committing to predefined rules, you protect your capital and maintain consistency, which is the foundation of long-term success. Another component of sustainable sessions is prioritizing quality setups. Even if the market is active, only execute trades that meet all your criteria. Ignore maybe trades or setups that appear promising but fall short of your edge. This reinforces the 80-20 mindset. Your goal is to capture the 20% of trades that produce the majority of your results, not to fill your session with low-quality activity. Practical exercises can make these routines automatic. For example, set a timer for a 30-minute session. Practice scanning your pre-marked trades, executing only those that meet all rules, and journaling post-session. Over weeks, this becomes muscle memory, allowing you to enter high-quality trades with minimal cognitive strain. Reflect on session behavior, not outcomes. Avoid the temptation to evaluate your performance solely by profit or loss. Instead, analyze whether you followed your routines, executed trades according to plan, and maintained focus. Did fatigue creep in? Did emotional impulses surface? This ongoing feedback loop reinforces the rituals, rules, and discipline that enable part-time traders to succeed without burning out or compromising their 9 to 5 responsibilities. Short, high-focus trading sessions are effective only if your mind and body can sustain them over the long term. Part-time traders often underestimate the cumulative effect of work stress, sleep deprivation, and inconsistent routines. Long-term consistency requires integrating mental, physical, and procedural support systems to protect your energy and decision-making capacity. Sleep is the foundation of cognitive performance. Even one night of reduced rest can impair judgment, increase emotional reactivity, and diminish pattern recognition. For traders managing a full-time job, prioritizing sleep is non-negotiable. Schedule your trading sessions around your natural circadian rhythm. Early evenings might work for some, late mornings for others. Identify your optimal alert periods and protect that time with boundaries, both professionally and personally. Nutrition also plays a critical role. Stable blood sugar levels support focus, calmness, and patience during trades. Avoid relying on caffeine or sugar to push through fatigue, as these can amplify stress and impair risk assessment. Simple strategies, such as a balanced snack before trading or staying hydrated, improve clarity and reduce impulsive decisions. Physical activity acts as a reset for both body and mind. Even brief exercise sessions, walking, stretching, or light resistance training, reduce cortisol levels, improve mood, and sharpen attention. For part-time traders, a 10-minute workout before trading can be enough to shift from work stress into a focused, disciplined mindset. Workspace design is often overlooked, but crucial for sustainable performance. A clean, organized environment with minimal distractions signals to your brain that it is time to trade. Light, temperature, and ergonomics all influence energy levels. Traders who actively control their workspace report better focus, fewer mistakes, and reduced emotional reactivity. Accountability is another long-term tool. Maintaining a trading journal that records not only trades but energy levels, emotional states, and situational context allows you to recognize patterns before they create problems. Sharing your trades or routines with a mentor or peer reinforces discipline and creates external checks that prevent self-deception. Knowing that your decisions will be reviewed naturally reduces impulsive trading and strengthens adherence to your plan. Mental habits are just as important as procedural ones. Mindfulness exercises, reflection, and cognitive behavioral techniques strengthen emotional resilience. Part-time traders often experience heightened FOMO or frustration from limited market access. Learning to recognize these triggers, pause, and respond rather than react ensures your trading remains deliberate, not impulsive. Over time, these mental habits reduce stress and protect your capital. Integrating long-term routines around trading also includes defining clear boundaries. Avoid expanding sessions beyond your planned high-focus window. Resist the temptation to chase losses or take extra trades simply because the market is moving. Consistency comes from following your structure, not reacting to short-term market fluctuations. The 80-20 principle applies here as well. Invest energy in the trades that matter and let the rest pass. Another layer of resilience comes from viewing trading as a skill to refine, not a quick-win opportunity. Your focus should be on learning, pattern recognition, and improving execution within your limited trading window. By shifting attention from profits to process, part-time traders reduce pressure, minimize emotional mistakes, and create sustainable growth. Building long-term consistency requires patience and a realistic approach. A one-hour session executed well each day accumulates exponentially over weeks and months. By protecting energy, following structured routines, maintaining accountability, and prioritizing high-quality trades, part-time traders can achieve results comparable to full-time traders without burning out or sacrificing their careers. Trade in alignment with your energy, protect your mental and physical health, and you'll achieve consistent results without compromising your 9-to-5 career. The 80-20 principle is not just about efficiency. It is about designing your trading life to work with your full-time job, not against it, ensuring long-term profitability, discipline, and freedom.